Since many investors work with major Wall Street firms to protect and grow their nest eggs, a fair question is, how helpful were expert stock market forecasters in 2008? Since we covered the 2008 S&P 500 forecasts in detail in an article that we'll reference and show you how to find, we'll take it a step further in this video by showing 2008 stock picks from Wall Street experts, and then we'll close the video answering the question, how does the observable evidence look now in 2014? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll move to the stock picks next. If you want to find the detail on this and how it potentially impacted retirement plans, you can Google this title here and find the detailed analysis on our blog Short Takes or on Seeking Alpha. It takes this table quite a bit further and does an analysis on portfolios and the hit potentially to retirement income. Our fair response to the poor 2008 S&P 500 forecast from Wall Street experts could be, I don't invest in the S&P 500. I use their expertise to invest in individual stocks. The following 2008 expert stock picks were published in a USA Today article dated January 2nd, 2008. You can find it by Googling 2008 predictions for the S&P 500. On January 2nd, 2008, one Wall Street expert recommended buying AT&T here at the beginning of the year. The rationale was the telecom's dividend is on the rise. Unfortunately, AT&T dropped 28%, which highlights the importance of total return and not focusing only on dividends. Our purpose here is not to criticize the individual forecasters or firms, and that's one of the reasons why we refer to them as Firm A and Firm B, but rather to highlight the difficulty of forecasting and to try to make investors think about how forecasting should fit into their retirement plan and their plan to protect their nest egg. Another very well-known Wall Street expert was quoted in that January 2nd, 2008 article with this advice: overweight U.S. stocks over bonds. Unfortunately, SPY dropped 37% in 2008. We have to give this forecaster some credit. They recommended Pepsi. Why? Because pops and snacks will sell, recession or not. So at least they were talking about a recession here, which was helpful. Unfortunately, even consumer staple stocks eventually get whacked in a bear market. PEP, or PepsiCo, lost 26% in calendar year 2008. Forecasting is extremely difficult because of the number of moving parts in the financial markets, including the Fed and systemic risk and speculation. The rationale for recommending Citigroup from one of the Wall Street experts in early 2008 was Citigroup has a brand that's as strong as Coca-Cola and it's cheap. Both of those are somewhat comical given what happened in 2008. Again, in fairness to the forecaster, they did not know what was going to happen, but we're trying to highlight just that. It's very, very difficult or next to impossible to predict the future, and it's even harder to predict how investors in aggregate will respond to those events. The rationale in early 2008 for one expert recommending General Electric, multi-year laggard, can post double-digit profit growth. As the financial crisis started to evolve, we figured out that General Electric really was not necessarily a diversified industrial, but more like a giant financial services company or bank in disguise. One expert recommended buying financial stocks in January of 2008 because the shares are down big, but the credit crunch will ease. Unfortunately, XLF lost 55% in the subsequent 12 months. Procter & Gamble may have seemed like a fairly conservative and rational choice. Unfortunately, it lost 14% in calendar year 2008. The next expert diversified his picks, not a bad idea, said to buy tech, healthcare, and consumer staple stocks because of predictable earning streams in tough times. Kudos to this forecaster for acknowledging tough times. Unfortunately, the triple Qs lost 42% in calendar year 2008. The second recommendation, healthcare, XLV, the ETF, lost 23% in 2008. You would think consumer staple stocks might have done well given the weakness in the stock market, but the bear eventually gets almost every single stock, which is why it's difficult to stock pick your way out of a bear market. Even XLP, not a bad recommendation, dropped 15% in 2008. The rationale from one Wall Street expert to recommend Legg Mason or asset managers in early 2008 was that unlike big banks, stocks like Legg Mason won't be victimized by mortgage defaults. That strategy may have sounded good on paper, but forecasting is difficult. Legg Mason got whacked in 2008 and dropped 69%. The other asset manager recommended in the USA Today article, T. Rowe Price, lost 41%. In summary, did the stock picking help, and could you have stock picked your way out of the bear market? Well, as we can see, SPY, this is the S&P 500 ETF, lost 37%. This was one of the picks. One of the picks said to overweight the stock market. Out of all the 12 picks mentioned in the article, and we're showing them all, we didn't pick the good ones versus the bad ones. We're showing you every single pick in the article. The average loss was worse than SPY at 40%, and the median loss for all of them was worse than the general stock market, once again showing that it's very, very difficult to add value with stock picking in a bear market. Before we move on to 2014, we just want to emphasize the real valuable information is in this post that you can find by Googling this title. Why have we taken a break from our normal videos in the past 2 weeks? Because the market looks bullish and there's really not that much to talk about. These are our moving averages that we discussed last week in the 2008 Could Investors Have Done Anything Different video. This is the look as of the close on Friday, June 27th. Price is above all the moving averages. The fastest moving average is on top, and the slope of the slowest moving average on bottom is up and bullish. This is a full-bore bullish look. If you don't know what that means, you can find how to use these moving averages and how they were helpful in 2008 and how they can be helpful conceptually going forward. The market model is a lot more than these moving averages, but the concepts apply. To find the detailed description of how to use those moving averages, you can Google this title. You can find it on Seeking Alpha or on our blog. And in that write-up, you can find the video, or you can find it on YouTube by Googling this title here. We just want to make sure we're taking care of our regular viewers. This is the weekly S&P 500 chart. It still has a full-bore bullish look as of the close on Friday, June 27th. A few weeks ago in one of our videos, we showed a bullish breakout on the NASDAQ and a bullish moving average crossover and a full bore bullish look. We own technology stocks. They did well this week, up 0.68%, and they still have a full bore bullish look on the weekly chart as of the close on Friday, June 27th. Is everything perfect in the 2014 markets? No. If you're looking for a glass half-empty chart, you can look at the credit markets, JNK divided by TLT. You can see it had a rough week. Still looks okay here, but starting to look a little bit more vulnerable. It doesn't carry a very heavy weight in the model because of its somewhat sketchy correlation to the S&P 500. It's helpful. It's just not as helpful as some of the other charts and ratios that we use. Regular viewers and clients know that we ask binary and unbiased questions. Is price above blue? Is price above red? Is blue above red? Is the slope up? S&P 500 risk on weekly relative to the VIX Fear Index risk off as of the close on Friday, June 27th is maintaining the bullish breakout and the full bore bullish look. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.